We're live now, Rick. Get that roll. There we go. Rick, I'm just going to go through a couple of these charts and just talk about the macro, the big picture. I've been trying to drive these things home for my clients for quite some time. The risks of a flat market for a decade, the risks of the debt, no way out of our debt, and the things like that. So I'd like to kind of go over some of those things with you, if you don't mind. So I'll share some screens. And then you're the one that it has the expertise in the commodity space. I have the thesis that the unloved commodity space will probably be something that's understood if that's the way to describe that, misunderstood. So trying to describe what commodities can do and why they're in our accounts is important, as opposed to I don't need NVIDIA, but I do need copper. There's certain things that we will have to live on. NVIDIA probably couldn't live without copper and some of the other metals. So anyway, I'm gonna go through I'll try to share a screen. I'll go through a couple of charts. I wish I could get out of that, Vance. There you go, Rick. I'm gonna just share a screen over here. We're gonna hit on a couple of charts here. Well, number one is we call this the Buffett indicator in here. And just the evaluations in the overall market are just at these levels that we've never seen. We last updated this in the fall. I don't know if you can see that, Rick. This is what we've shown as a Buffett indicator, the standard deviation of two times plus the value of the stock market to the GDP. Something unprecedented. Makes me worried for equity valuations that's just complacency that is going to kill the cat, so to speak. So extreme valuations. We'll hit a chart down here. The S&P index. The concentration risk in these 8 to 10 stocks that are overvalued. Everybody says it's different this time because they're actually earning money versus the dot-com bubble where they weren't earning money. That's a worry there. For me, the debt ratio. This is a chart that I have shown to clients. This is a gross federal debt as a percent of the GDP. Coming into World War II, we were 120% of debt to GDP. We are back there, but we're not fighting a war as far as I can tell, at least not in two different theaters across the globe. We got the debt down to GDP to about 30% in 1980, which I believe was about 980 billion in the early 80s. Now we're at 40 trillion. I think the way I would count, it's probably more than that. And on top of that, something that really worries me is the labor force participation rate. Coming into the 70s, where moms went to work. In the 60s and 70s and 80s, we had a growing population adding to our tax revenue. Now it's way down by a percentage. That chart looks pretty horrible. So how are we going to pay off our debt and our deficits? I don't think there's any way out of the debt deficit structurally. We can all hope that we can pay it off, or we come together and have a consensus between the political divide that would lead us to a path of sound money. I don't see that in the offing with all the tension out there. I just don't see that in the cards. So a big worry for me, this last chart, this last one I'll kind of hit on, I think, is the Dow Jones of the 70s. I've shared this with my clients over the years, and the Dow could not break 1,000 points until 1982. We hit that in 1965 when I was 2 years old. And when I was 20, the thing finally broke above 1,000 and moved up. So if you're a retiree taking money out of your 401k at 4 or 5%, and you go flat for a decade, you'll be out of money at the end of the decade, likely, unless you really understand how markets work. And I just have a belief that history is unkind to those that aren't educated to the risks of the market. With the everything bubble and the Federal Reserve backstopping every major issue that we've had since the dot-com bubble, the great financial crisis, the Greenspan bubbles, as I would call them. I don't see a way out of this whole thing. So anyway, your thoughts, Rick, especially in the commodity space?
Well, I would suggest that paradoxically, you might have understated the risk. The first is, and I don't want to go to your valuation chart because I need to say I am expert at valuing natural resource-based businesses and probably conventional financial services-based businesses. So those components of the S&P 500 that are within my competence, I can talk about valuations on. I don't want to get into the game of trying to understand how to value consumer durables or consumer expendables or technology stocks because I don't know how. But the rest of your charts I can talk to a lot. When you talk about debt as a percentage of GDP, you leave out the most horrific part, which your customers need to understand. While the on-balance sheet liabilities of the U.S. government, their debts to bondholders, exceed $38 trillion and will very, very, very soon eclipse $39 trillion, the much bigger concern is the net present value of unfunded entitlements, Medicare, Medicaid, Social Security, federal pensions, military pensions. That number, according to the Congressional Budget Office, is $120 trillion. Now, we may not technically owe the money, but many of your clients intend to be beneficiaries, and they believe those promises are promises that are going to be kept. If you add those two obligations, let's call it $40 trillion in bond debt and $120 trillion in the net present value of liabilities, the number that you come with is very close to $160 trillion. And to put that in context, the Internal Revenue Service says that the private net worth of all Americans combined is $167 trillion. So I would suggest that your debt slide understates the risk, which is something that your listeners, your clients need to pay real attention to. Labor force participation is problematic too, both for the reasons that you described and for a different reason, which is to say that the educational and skill set level of an important part of the American labor force is insufficient to generate enough utility for their customers that they can be paid compensation, the compensation that's required to maintain their standard of living today. Many workers in today's economy don't have enough education to employ enough technology that they can generate sufficient utility to their customers and hence their employers to generate the type of wages that are required to enjoy a middle-class life in the United States today. And that's a huge problem. By the way, I don't have an answer for it, but I think it's something that your clients need to consider in terms of how they plan for the future. The risk with regards to equity markets needs to be quantified. Unlike you, I was cognizant for that bear market. In the period 1968 to 1982, U.S. equity markets were flat to down. That coincidentally coincided with a good part of my time as a young stockbroker. I had the incredible good fortune of being in natural resources, where my client accounts increased every day, and most of my peers watched their client accounts decrease every day. It was much more pleasant to be me than it was to be them. I would like you to have added one more chart, which is the perniciousness of inflation on savings. Many of your clients believe that the deterioration of the purchasing power of their savings is best measured by the CPI. But I would submit, Chris, that the CPI is wrong. Among other things, it doesn't include food or fuel. For those of your clients that don't either eat or drive, I guess that's relevant. It also doesn't include tax. So I would ask your clients to ask themselves whether or not tax is an important part of their cost of living. The point of all this is that if you look at the basket of goods and services, Chris, that you've consumed in the period, say, 2020 to 2025, what you will find is that the basket of goods and services that you consume has escalated in US dollars terms by about 8% compounded. And here's the rub. If you're making 4% on your deposit products and you're losing 8% in purchasing power, Far from receiving 4% a year, you're losing 4% a year. And if you extend that out against the client that you have that is planning to take 4 or 5% a year out of their capital to live on for the next 5 years or 10 years, considering the fact that their purchasing power is declining by 8% compounded, they simply, Chris, need to alter their plans. And it gets worse. If, as I suggest, or rather, as the Congressional Budget Office exists, the total liabilities at the federal level is $160 trillion. The rate of deterioration of the purchasing power of the US dollar is going to escalate, not decline. The only way out of the debt circumstance, I would suggest, is either a default, where we say to old timers like me, you ain't getting your Social Security. And we say to the bondholders, yeah, we contracted the debt, but we aren't paying. Or a different type of default, a dishonest default, where we honor the nominal value of obligations, but we inflate away the net present value. And that's what I think is going to occur. The big issue for your clients is maintaining their purchasing power for the next 10 or 20 years of their life.
Yeah, I agree with option two. There's no way out of the debt, and the inflation is the way you get out of it without really. It's harmful. Yeah, I mean, there's no way out of it. I once asked a pastor friend of mine if debt is a sin, and he said no. And I said, well, what if you know you're not ever going to pay it back? And to that he had no answer, because he would do that. He would go into knowing that there's no way congressionally, there's no way out of this. In my humble opinion, and I would hope that I'm wrong, but hope it's not an investment strategy. I hope that we have a better way out of this. And I started using hope as not a strategy during COVID. There's no way out of this. We hope we have 2 weeks. We hope it just seems dangerously naive to not be aware of the risks.
Let's quantify it for your clients. The U.S. Budget Office, Congressional Budget Office, suggests that the gross federal income from all sources, taxes, tariffs, fees, is about $5 trillion a year. They also tell us that the on-balance sheet liabilities of the U.S. government, the debt to bondholders, increases by $2 trillion a year, and the net present value of unfunded entitlement promises increases between $2 and $3 trillion a year. So their gross federal income is $5 trillion, and the increase in the debt by a conservative measure is $4 trillion. That means that you have to service these liabilities in the future with $1 trillion in federal income. How does that work? That's what your clients need to ask themselves. If they don't have an answer, then it's incumbent on them to plan for their own future and understand that the Commonwealth, we the people, aren't going to sustain their lifestyles for them.
It's a concern I've expressed many times. We look at the last 40 years and it looked easy. The markets do this. We have a bank account that does better than an investment account that considered a savings account that earns a plus 9% a year, and we're going to be fine. Not understanding that the debt to support that is unprecedented. We have this going back prior to Greenspan. Volcker, I don't think would have done this, but that he's long dead. So not understanding how to protect your wealth is really important. You have a store of value. I hold up a dollar. In fact, somewhere in here, Rick, I have a silver note, a couple silver notes, and I have a couple of Reichsmarks from Germany, the Weimar Republic, that were handed down from probably great grandfather who had just a bit of German in him. So it's a $2 million mark. That's hyperinflation. That's I don't think we're there yet. I don't think we're going to be that, but somewhere between complacency and hyperinflation. And to America, I don't know what that means. Globally, it's 340 trillion or so of global debt. So the globe's in the same situation. I don't know how you'd speak to that. One of the things that just it seems like there's in terms of store of value, most of the clientele are hitting retirement ages, and you have a store of value, and it's precarious to think we're just going to have the same thing in the next 40 years. I've told my clients time and again, the next 10 years won't be like the last 40. And I think that's why I at least think that. Let's hope it is. Can hope it's not a strategy, but let's just assume that we're going to go through a more difficult period for various reasons, politically, economically. Debt is debt is a wedge against efficiency in economic terms. And no good household had more debt than they could pay off. No good city, state, locality has ever gotten out of debt that's taken on too much debt with no plan to pay it off. So
Let's begin by asking your clients to consider the fact that it is highly likely that the purchasing power of their savings declines at 8% compounded. Then let's ask them what their income will be for the next 20 years and ask them what they believe that their expenses will be, escalated 8% compounded, and ask them if they have sufficient income, pardon me, and sufficient savings to fund their standard of living. I would urge each of your customers to do that. Do the simple arithmetic. Forget whether they're Democratic, forget whether they're Republican, forget whether they're white or black or brown, you know, forget everything. Just bring it down to math. What do you have? What do you need? And if there's a delta, how are you going to cover the delta? Another thing I feel sort of compelled to comment on. Well, two things. One, in your discussion, you talk about the fact, which I agree with, that the last 40 years has been the most benign 40 years materially in human history. And at the same time, our country has squandered that time. We have taken our debt as a percentage of GDP from 18% at the beginning of this bountiful time to 115% today, if you don't account for the net present value of unfunded entitlements. If our track record in good times is that horrific, what does our track record look like in bad times?
It doesn't look pretty.
And I'm not asking your clients to wail and moan and go hide in the corner in fetal position. That guarantees you'll lose. I'm asking your clients to think about the circumstance that confronts them in arithmetic terms and begin to confront it. Begin to do something about it. That's all.
Yeah, math scares people. In fact, at the conference last year, I asked. I was on the cruise, and I asked two of the guys. I can't mention the names of the companies, but I was pleased they're asking my opinion on why I think it's important. And I said, well, one, I take math, and I take history, and you combine these two events, and you're like, the math is not kind to those who are historically ignorant. Because math is real, and gravity will grab this thing, and the gravity is going to find us, and it's going to be when we're least expecting it. And I think we're starting to find that now with the desperation of people. If you're driving for Uber or DoorDash, and I have a client who's a lot of his workers at his plant where he works in Arizona, and that's off time, they are working for DoorDash and Uber, and they were really middle class 2 years ago. Now they're driving for extra money. That's inflation. That's just flat out. That's the early stages of inflation. I don't know when that ends, but that's a desperate move to stay ahead when you already have a full-time job and you're taking a part-time job just to get you where you were, 6 years prior.
That's correct. One other thing I'd like to say, and I'm not sure that passed as prologue, but beginning in the year 2000, I took it upon myself to begin to save in gold, but to maintain liquidity in US dollars. And if you maintain, as I do, an alternative account, even an informal alternative account in gold, you're struck by how cheap things are. The S&P 500, even with NVIDIA measured in gold terms, is cheap. Housing is cheap. Health insurance is cheap. If you measure those things in US dollars, they're extraordinarily expensive. But if you measure them in gold, they're cheap. And I'm not suggesting that everybody abandon the US dollar in favor of gold, because they don't spend gold, they spend US dollars.
Yeah.
But I would urge them to understand what happened in the past in the context of what might happen in the future, and diversify their savings types. Because it really is dramatic if you measure your purchasing power in gold rather than measure your purchasing power in other types of instruments. Gold, when people say to me, well, gold's, it's had a pretty good move for 2 years, but it hasn't stood the test of time. To them, I say, really? Gold for me in the last 25 years has increased at 9% compounded. How have your treasuries done?
Well, I guess it's not as sexy as a tech stock. I own Google, I own Amazon. The calls I had from clients asking for certain sectors or stocks or AI, and we've gone through solar stocks. We've seen these things before, and without a fundamental understanding, I've asked clients, when you buy a stock, why are you buying a stock? You know what you're buying. Why are you buying that stock? Well, that's going to go up. I go, well, we don't know if it's going to go up. There's a lot of factors that could bring it down as well as move it up. So it's the lack of just complete understanding, and that to me that's the complacency because the last 40 years has taught people markets can come down. The Fed, they don't know why it goes back up. Liquidity is shoved into the market from the Federal Reserve and Congress, and helicopter money comes down from the skies, and we're all happy until inflation hits, and then we're not happy. I don't think so. On the cycles, Rick, I was going to ask you a question on the cyclicality of the unloved sector of just basic commodities versus paper stocks. What the thoughts on that in general?
Well, I don't want to criticize the paper stocks because for many of them, I don't know how to value them.
Yeah,
So I don't want to tell you that NVIDIA is overpriced because I can't spell it or pronounce it.
yeah,
Now, cyclicality, I can go there.
okay,
Commodity stocks are, in their own way, extremely predictable, precisely because of their cycles. And that's what I like about them. Historically, I had Paul Stevens as a client, the Stevens of Robertson Stevens, the dean of Bay Area technology underwriters. And the more he described technology businesses, the less attracted to them I was. Simply because they were so complex that I felt that by the time I understood them, they'd be obsolete.
probably so.
That doesn't mean that smarter people than I, like Paul, shouldn't have invested in them. It meant that I shouldn't invest in them. What I have learned is that with regards to commodities, if you invest countercyclically, time is on your side. Specifically, if you find a commodities asset class where the continued supply is essential for the material well-being of humankind, say energy or food or water, and that commodity is priced below the total cost of production, one of two things happens. Either it becomes unavailable to people or the price goes up. Those are the only two alternatives. There aren't a whole bunch of other things. Water never becomes redundant. Water never goes out of style. Water never gets replaced by technology. And that's important because right now, as an example, oil and gas, it is arguable that if you include the cost of capital and social rents, taxes and royalties, that the price of oil is below the total cost of producing oil worldwide. If that's true, there's only one of two possible outcomes. The first is that 5 years from now, your car won't start. The second is that the oil price goes up. I would ask your customers to ask themselves, which is more likely? I don't want to say that oil is better than technology. I want to say that oil is more predictable than technology. It's simpler than technology. So for Rick Rule planning his financial future, given that I have no way to value NVIDIA or assess its future products, I personally, as a consequence of my own ignorance and laziness, stick with oil. A great investor named Warren Buffett said that he didn't make as much of his money by thinking as he did by sitting. That he liked investments that required of him, quote, sloth and lethargy, both of which he said he had in abundance. And as I age, that's become increasingly important to me. It isn't that I need to make all the money that there is to be made, by taking risks that I can't quantify. What's essential to me is that I make enough money to sustain my family's standard of living reliably over time with the facts that are at hand within my capacity to understand them. And that's where natural resources and precious metals, I think, really come into play.
Yeah, the hardest thing to understand is something you've never believed in, I believe, because there's not an earnest want of education to it. I've tried to explain to clients that we do have some of the precious metals in the accounts, but gold I believe dropped from 200 to 100 in the 70s before it went to 800. And if you added it today, what's your time horizon? What's your risk tolerance, even for something that has accretive ability, no predictability, but accretability to the accounts and to your wealth. If it's not understood that volatility, has to be understood, and it matters, because if you don't understand it, you're not going to be happy.
I would never advocate that anybody have anything approaching the majority of their portfolio in gold. I would point out too, however, that while volatility is unnerving, it's a fact, and people need to acquaint themselves with that fact. Let's look at that. Let's look at the whole of that bull market that you described. Let's look at, first of all, if somebody had bought gold in 1970, at the beginning of that decade, and held it to today, they would have almost a 10% compound internal rate of return, despite that 50% drawdown. Not a bad outcome. As you say, people don't like 50-year terms. So let's narrow it to the period 1970 to 1980. In that period, the gold price went from $35 to $850. A lot of fun. I was there, by the way. Investor behavior, the first part of the decade, from 1970 to 1975, the gold price went from $35 to $200. People loved gold. They believed in gold with the passion that the choir at a Baptist church might believe in God. In 1975, the gold price fell from $200 to $100. And those same passionate followers believed that they never learned to spell gold. And they got shaken out of a market at $200, where if they had had the courage and the knowledge of their convictions and hung in, they would have enjoyed a move from $100 to $850 in 5.5 years. Now, while it's difficult to psychologically prepare for a 50% drawdown, whether or not it's difficult doesn't matter, because it's true. It's a fact. It's much more difficult for most people to understand that the debt and deficits that we enjoy today, if that's the right phrase, will necessarily, arithmetically, result in the deterioration of the purchasing power of their savings by 75% in 10 years. This isn't a drawdown that might occur. This is a drawdown that happens as a function of arithmetic, just subtraction. That's all you need to know. So it's weird that people are really concerned about potential volatility in an asset class, and they ignore systemic risk, which is arithmetically proven. I'm not trying to say that volatility is pleasant. I'm just trying to say that if your fear of volatility causes you not to take steps to avoid the inevitability of the deterioration of your purchasing power, you're either lazy or a fool.
Rick, I had a new client that came in, I don't know, a few months ago, and how I started the meeting, I don't know how I started the meeting, but it was like, how would you like to lose 50%? I'm not trying to be clever, but if you put your money under the mattress and 5% inflation, 10 years, that's 50% loss of your purchase. That we might even have worse than that, but that's just an easy decade with inflation at 5%, which apparently we have that right now. So money under the mattress, you lose 50% of the purchasing power of that unit. dollar, or if you buy a basket of S&P stocks, you might have the same outcome. So it's going to require a lot more effort and education to understand what we're up against. That's the whole point of, I guess, asking you to take the time to spend with us today is boy, it's going to be challenging. Are you ready for it?
It is going to be challenging. It's absolutely going to be challenging. And the first part of that is just understanding the baseline facts. You can't deal with the problem if you haven't quantified the problem.
Correct.
Which is why every single interview I do, I try to acquaint people with the arithmetic of the size of our economy relative to our obligations, and the fact that without a quantum improvement in technology, which we could enjoy, I'd love to see it. Without a quantum improvement in technology, the purchasing power of US dollar denominated savings will fall by 75% in 10 years. It's just simple math. And by the way, I think the US dollar will do okay against other fiat currencies. I'm not suggesting that people diversify into Canadian dollars or Ugandan cedis or euros or something like that. I'm just suggesting that people understand the arithmetic of their future.
Yeah, well, I agree with you, Rick. We're almost at 40 minutes. I appreciate your time. I look forward to talking to you again real soon. I'll definitely see you at the conference this summer. I look forward to that as well. But Rick, I immensely appreciate you taking the time with us to help educate clients as to what we're up against and why we're trying to explain things in an educational sense the best that we can, because I think we're up against something a little different. That's my opinion. It doesn't mean it's going to happen. That's just my opinion. So.
Well, I would ask your clients who want to hear more, in other words, if they want to be depressed by me as opposed to you, to visit my websites. Rule Investment Media is free, and the Rule Classroom, where you learn how to invest in natural resource and precious metals securities, is also free. RuleInvestmentMedia.com. If you list your natural resource stocks, I personally will review them for free. Pretty good price. Rule Classroom, 300 hours of instructional programming for free. Of course, Chris, that comes with an absolute money-back guarantee.
What was it? As I walked out of the conference last summer, I said, I just caught you in passing. I said, Rick, I think I learned about 10% of what the knowledge was in this room at these 4 days, but I didn't. I walked out of there kind of dazed. There's a lot to take in. There's a lot to understand and the complexities of the world we're living in and how to benefit from that chaos, if to the extent that we can. And that the intent here is that we make that attempt on behalf of our clients. So
I hope, as an attendee of the conference, that you did or will access the recordings.
I've had a really busy year this year, so I have not had a chance to review those. But Vance,
I've reviewed a few of them.
Yeah, Vance has, yeah.
I put on the conference myself, so I'm supposed to know all that stuff.
Yeah.
And I had to play the recordings.
Yeah, it's a lot. It was some of the best economic minds, I think in the world attending. It was well worth. Probably one of the best ones I've been to was that conference. I've been to many, many, many. That was the one I think I had the best outcome leaving it. So I appreciate you.
I'll do my best to make this coming one better.
Okay, sounds good. I look forward to seeing you, and I appreciate your time this morning. Okay.
Thank you, sir.
You have a good day.
Thanks,
okay.
sir.
All right. Bye-bye.